Welcome to the deep dive. So, if you're plugged into the financial world right now, you're probably feeling it too, that kind of low-grade hum of anxiety.
Oh, yeah. The feeling that the next big one, the next market crash, is
Yeah.
maybe just lurking.
Exactly. And it seems particularly fueled, doesn't it, by this almost unbelievable surge, near vertical, in everything AI.
Absolutely. It's hard to ignore.
Right. So our mission today, we want to try and cut through some of that noise. We've looked at a whole stack of sources, everything from, historical market manias way back to some really quite dry stuff on modern infrastructure logistics. And we've boiled it down to basically two core questions. First, are there specific patterns that always seem to pop up before a crash? And second, is it even, remotely possible for anyone, any expert, to actually predict when that turn might happen?
And we think we can set up a framework here. Because crashes, they aren't really chaotic, not totally random anyway. They follow patterns.
Yeah.
Patterns rooted in, economics and, frankly, human behavior. We like to call it the structural rhyme. And to really get a handle on today, we're going to compare two big tech eras, the dot-com boom back in the late 90s.
Right.
And this current AI rush. See if we can find that overlap, that rhyme.
Okay, let's unpack that structural rhyme idea first, because it sounds like the central thread tying these two massive tech booms together.
It really is.
The core idea, reading through the sources, seems to be this. Progress, technological progress, just outruns the system that's supposed to deliver it. Optimism, it kind of quietly gets ahead of physics, and policy too.
That's the essence of it.
But I have to push back a bit here. The internet boom, a lot of that felt built on pure speculation, right? Businesses with maybe fuzzy monetization plans.
Definitely a lot of that. Eyeballs over earnings.
Whereas AI today seems built on clearer enterprise needs, actual workloads. So doesn't that change the risk? Why is this structural rhyme idea still hold?
That's a great question, and it's crucial. The rhyme holds because, the revenue quality might feel different this time, more solid maybe, but both eras created a critical choke point, a bottleneck.
A bottleneck, where the profits gather.
Exactly. Both breakthroughs created a fundamental scarcity that the market then, maybe violently overpays to solve. Think back to 99, the dot-com boom. What was scarce then? Fundamentally, it was bandwidth, moving bits fast enough.
Right. Dial-up nightmares.
Yeah. So where did the capital flood? Into solving that, telecoms, financing huge fiber optic networks. That was the bottleneck.
Okay, got it. So today's AI boom, what's the scarce resource now?
It's more complex this time. It's a whole stack, really. Computing power, obviously, those specialized chips, but also enormous memory bandwidth, massive cooling systems.
And just raw power, electricity.
Tons of it.
Yeah.
Reliable megawatts. You can't run these huge language models on, hopes and dreams. You need electrons, lots of them.
So if the scarcity mechanism is the rhyme, what's the big market mistake? The thing investors get wrong in both eras. Is it the same mistake or slightly different this time?
We think the mistake is fundamentally identical. It's mistaking a short-run constraint, something temporary,
The bottleneck.
for a permanent, enduring business model. That failure, that's what drives the capacity mismatch. That's where the real danger, the risk, lies.
Capacity mismatch. Explain that.
Okay, dot-com era first. The fix for the bandwidth scarcity was physical stuff, right? Fiber optic cables, routers. But that new capacity, it didn't arise smoothly, gradually. It kind of bunched up.
All landed at once.
Pretty much. And the moment that supply exceeded the actual demand, boom, that capacity instantly flipped from being this amazing profit engine to just inventory. A huge problem.
And that led to the big write-downs, the bankruptcies in 2001.
Exactly. The scarcity premium just vanished almost overnight.
Okay, fast forward. AI mismatch today. We're seeing that friction, that capacity issue, but maybe playing out slower.
It feels slower, yeah.
Yeah.
Because financial capital, investment money, it moves at the speed of light, right?
Yeah.
Demands returns now.
The physical stuff?
But physical capital, building data centers, getting permits, laying high voltage lines, that moves at the speed of, concrete, copper, steel, environmental reviews.
Stuff takes time.
A lot of time. The constraint today is physical reality. It's the queue to connect to the grid. It's the transformer factory saying, yeah, we can deliver that in 2 years. It's the permit process.
You can order the chips, maybe get them quicker now.
Sure, but you can't move electrons if there's no path built for them yet.
And that North Virginia example really hits this home, doesn't it? It's like the global center for data centers.
So absolute epicenter.
And yet projects are backed up for years, just sitting there waiting for the utility company to physically connect the power.
Waiting for electrons that literally haven't arrived.
So we're talking basic physics and logistics that investors are kind of financing past,
Hmm.
hoping to solve with money.
And that mismatch gets worse because of two big economic risks. First, this whole strategy of pre-provisioning the future. Companies committing huge capital now for revenue that might only show up way later.
But the depreciation on that expensive gear starts ticking immediately.
Every single quarter, whether you're using that capacity fully or not. So capacity lands way ahead of utilization sometimes.
Okay, what's the second risk?
Efficiency risk. These AI models, the algorithms, they're getting better fast. New architectures, techniques like distillation, they mean you can do more with less compute.
Ah, so if today's algorithm needs, say, 40% less power tomorrow to do the same job,
Then all that expensive capacity you just bought and installed, it suddenly becomes less scarce just through math alone. And those juicy scarcity profits, they start to fade.
fast. That difference is fascinating. Physical limits today versus maybe more pure tech optimism back then.
Although both had elements of each, the emphasis shifts.
Right. But these physical constraints, they're really just the modern version of these timeless patterns, aren't they? Human behavior, financial systems.
Absolutely.
So let's step back from AI specifics for a second. Mark Twain's quote, right? History doesn't repeat itself, but it often rhymes. What are those fundamental rhymes? Those, say, four patterns that seem to show up before every major crash.
Okay, pattern one is the big one, maybe the most fundamental. Rampant speculation and investor overconfidence.
Like tulip mania.
Classic example. Starts back in 1634, Dutch Golden Age. Tulips become this huge status symbol. Prices just went insane.
How insane.
At the peak, some single bulbs were trading for the equivalent of 5 years' average salary, maybe $200,000 in today's money, for one tulip bulb.
Wow. But it wasn't just the flower being expensive, was it? There was a financial innovation angle, too.
Exactly. The key was the invention of, well, a kind of primitive futures market. People weren't just trading bulbs, they were trading paper contracts for bulbs they didn't even own or hadn't received yet.
So the trading became detached from the actual tulip.
Totally detached, driven purely by flipping, by the confidence someone else would pay more, not by the underlying value of the flower itself. Pure speculation.
Okay, that's pattern one, speculation. What's pattern two?
Pattern two is when the system itself falls behind. Regulatory shortcomings. Think about the lead up to the Great Depression in 1929.
The Roaring Twenties.
Right. You saw this explosion of new, largely unregulated financial tools, especially these things called leveraged investment trusts.
Leveraged, meaning they borrowed money.
Yeah, they didn't just pool investor cash. They went out and borrowed more money on top of that. Huge leverage, which magnified gains on the way up.
And losses on the way down.
Catastrophically so.
And the government context there, how did that run wild? Sounds like the rules just weren't there.
Or weren't enforced. The policy was very hands-off, laissez-faire. Minimal oversight was seen as good for business. President Coolidge famously said, "The chief business of the American people is business."
So that atmosphere let these trusts.
Trade at crazy valuations, sometimes double the actual value of the stocks they held inside them, because the system, the regulations, just couldn't see or account for all that hidden debt underneath. The guardrails hadn't kept up.
Okay. Pattern three.
Pattern three is about technology moving maybe too fast for us to really grasp. New, poorly understood innovation. The key case study here. Black Monday, 1987.
What was the innovation then?
It was something called portfolio insurance. This was early days of computers and finance. Algorithms were designed to automatically place small trades, basically betting against stock drops if the market started to slide, like a digital seatbelt for your investments.
Sounds smart in theory.
In theory. But the system was so complex, even the big banks didn't fully understand the aggregate risk. What happens if everyone's computer tries to hit the sell button at the same time?
The flaw.
The fatal flaw. When the market did start to slide, all these automated insurance programs kicked in simultaneously. Instead of protecting, they created this massive self-reinforcing selling avalanche.
The system designed to prevent the crash actually caused it.
Led to the worst single-day percentage drop in U.S. stock market history. Still is.
Wow. Okay, finally, pattern four.
Pattern four, and this one feels very relevant to recent memory. The buildup of debt. Best example, the 2008 housing crisis.
Right. After the dot-com bust, people wanted safe assets.
Exactly. Money flowed out of tech stocks and into things that felt tangible, solid, like housing. Banks then got creative, packaging mortgages, even really risky ones, into these complex bonds. Mortgage-backed securities, CDOs,
All those acronyms.
all those acronyms, and household debt just ballooned. It was all built on this one seemingly unshakable belief.
Housing prices never go down.
that fatal assumption. When it proves spectacularly wrong, the whole system, which was massively interconnected through these complex debt-fueled securities, just seized up. Lehman Brothers fails.
Global financial crisis.
The lesson there. When debt gets big enough and hidden enough and interconnected enough, it turns risk in one asset class into risk for the entire system.
Okay, so we've got these four big patterns. Rampant speculation, rules not keeping up, new tech nobody fully gets, and debt piling up.
Yep, those are the horsemen.
And looking at the AI rush today, you can definitely see elements of, well, speculation and maybe new complexity, right?
For sure, the echoes are there.
But here's the kicker. If these patterns are so clear, so historical, and we have literally thousands of super smart, highly paid analysts, economists, gurus watching this stuff, why does the data say they're so bad at actually calling the turn? Why do they consistently fail?
Yeah, this is where it gets really humbling, I think. You look at the objective data, it's pretty damning.
How bad is it?
There was this one big study, tracks something like 6,582 forecasts, made by 68 well-known market experts over about 7 years, 2005 to 2012.
Okay.
Their average accuracy score, get this, 46.9%.
Wait, less than 50%. Worse than just flipping a coin?
Worse than a coin toss.
Yeah.
And importantly, none of the aggregate advice actually made money for investors once you factored in transaction costs. Let that sink in.
Okay. Wow. So if the actual predictive value is, frankly, terrible, why is there still such a huge appetite for market timing? Why do we keep listening to people who claim they can do it?
I think it boils down to incentives, the mismatch there.
How so?
Well, the predictors, the gurus, they make money or get famous or get clicks just by making the prediction. Whether it's right or wrong is almost secondary sometimes. There's an asymmetrical risk for them.
Meaning
They become world famous for one lucky, correct call. Think Michael Burry, right? The Big Short fame. Huge call.
legendary.
But they face almost no penalty for a string of bad calls later. Burry himself, for example. He had to basically apologize for being wrong when he told everyone to sell in 2023. The big crash didn't happen.
And then you've got the insiders, the big names like Jimmy Dimon. There's that running joke. He's predicted 22 of the last 3 crashes.
Right. Or Jim Cramer on TV making recommendations at an almost industrial scale. I saw one number, 725 buy and sell calls in just 1 year, 2021.
That's a lot.
It highlights that often what's being offered isn't really objective financial insight. It's closer to show business. Entertainment.
That makes sense. There's another factor, too, isn't there? Just pure randomness, luck.
Absolutely. Statistical variation. Nassim Taleb, who wrote The Black Swan, did this great thought experiment, a simulation.
Tell me about it.
He simulated 10,000 fake investment managers. Each year, they just flipped a coin.
Yeah.
Heads, they make money. Tails, they lose. After 5 years, guess what?
Some got lucky.
Purely by chance, 313 of those managers had made money every single year for 5 years straight. Just random coin flips.
So in a really random environment like the stock market with tons of people trying,
You're inevitably going to get people who look like geniuses just due to pure luck. And we're really bad as humans at distinguishing luck from actual skill, especially in hindsight.
Okay, so pulling this all together, what does this mean for you, the listener, watching this incredible AI surge unfold?
It means holding 2 ideas in your head at the same time. And it's harder than it sounds.
Okay, what are they?
Right. Truth number 1, AI is real. It's a genuine, durable, probably world-changing technological shift. That's not the debate.
Right. It's not tulips.
It's not Toulouse, but truth number 2, the market can still get completely carried away and vastly overpay, even for a real thing, especially when it confuses a temporary bottleneck like today's power and chip constraints with some kind of permanent business advantage.
So the underlying tech is real, but the valuation can still be wrong.
Massively wrong. The art then isn't predicting the crash. It's watching the signals, watching the physical and economic cues to see if the cycle might be turning hard.
Okay, practical takeaways. What should people be watching?
We can suggest 3 things based on the sources. First, watch AI pricing and resale values. Stuff like cloud computing instance prices or the resale value of used AI hardware.
What are we looking for?
If those prices start falling faster than the underlying cost of making the chips or providing the service, that's a big red flag. It tells you margins are getting squeezed across the board. The scarcity premium is fading.
Okay, pricing. What's second?
Second, keep an eye on market breadth. Right now, as we speak, market leadership is incredibly narrow.
Meaning just a few big stocks are doing all the heavy lifting.
Exactly. A tiny number of U.S. megacap tech stocks account for a historically huge chunk of the S&P 500's value and gains. Now, narrow breadth doesn't cause a crash on its own, but it makes the whole market much more sensitive. If just one or two of those giant pillars starts to wobble, the entire index feels it much, much harder than if the rally was broad-based. Fragility increases.
Makes sense. Okay, third thing to watch.
Third, watch policy, specifically policy related to those physical constraints we talked about.
Like the power grid stuff.
Yes, look for administrative signals that the physical limits are really biting. Things like grid operators changing the rules for how projects get connected, maybe prioritizing certain types, or local governments putting moratoriums on new data center approvals because the grid is full, or utilities changing their pricing structures, their tariffs, for big industrial power users.
Why is that important?
Because when constraints start being managed by rules and regulations, instead of just being solved by high prices, it means the problems are deep. And surprises, like sudden cost increases or project delays, tend to show up very abruptly in company earnings reports.
Got it. So watch pricing, watch breadth, watch policy. But the overarching message seems to be, don't try to be the hero who calls the top.
Please don't. It's a fool's errand. Remember, to successfully time the market, you have to be right twice. You have to sell at the absolute peak.
Which is almost impossible to identify in real time.
And then you need the guts and the skill to know exactly when to buy back in at the bottom. The odds are massively against you.
So instead of prophecy.
Focus on planning. Focus on an asset allocation, the mix of stocks, bonds, cash that genuinely matches your personal risk tolerance and, crucially, your time horizon.
Time horizon is key.
Absolutely. If you're a younger investor with decades ahead of you, you might actually welcome a crash. Seriously. It means you get to buy more shares, more units of good companies or index funds at cheaper prices. Your future self will thank you.
Plan, don't prophesy. I like that.
And maybe a final thought to leave people with, building on that .com comparison.
Okay.
The big lesson from the .com decade, looking back, was that society tends to adopt these huge platform shifts, like the internet then or AI now, much more slowly than excited investors initially expect.
Okay, slower adoption.
But ultimately, more completely than the skeptics allow. The path is always messy in the middle. There are hype cycles, busts, disillusionment.
So if this AI cycle does end hard, does crash.
The real punishment, the losses, will likely fall hardest on those who got caught in the mismatch. Those who committed capital, secured expensive hardware, locked in high-power contracts maybe right at the peak, only to face falling prices for AI services later on, maybe because efficiency improved or capacity finally caught up.
Which raises a really interesting question for you, the listener, to think about.
Will the ultimate long-term winners in this AI revolution be the companies that rushed in first, secured all that capacity at any cost? Or will it be the ones who maybe waited a bit, stayed more disciplined, and matched their spending, their capital structure, to the slower, steadier, sometimes frustrating pace of physical reality? Who wins the long game?